How does futures contract expiration affect your trades? Imagine holding a ticket to a concert that only lasts for a specific night. Once the night ends, you have to decide what to do next. Futures contracts work similarly, with a set expiration date that marks the end of the agreement. When that date arrives, it can change everything about your trade. Futures contract expiration means the contract's life is over. If you still hold the contract, the exchange will settle it based on the rules. This could be through cash payment, where the difference between the contract price and the final settlement price is paid, or through physical delivery of the actual commodity. Most traders prefer to avoid physical delivery because it can be complicated and costly. Instead, they close or roll over their positions before the expiration date. Rolling over involves closing the current contract and opening a new one with a later expiration date. This helps traders stay in the market without facing the obligation of delivery. It's a common practice, especially for investors who want continuous exposure to a commodity like oil, gold, or agricultural products. As the expiration date gets closer, trading activity shifts. Liquidity in the expiring contract drops because traders are moving their positions. This can cause wider bid-ask spreads, which means buying or selling becomes more expensive and less predictable. You might notice more price swings or sudden jumps in the market. Price volatility often increases near expiration because traders are adjusting their positions. Some might close out to avoid delivery, while others try to profit from price differences between futures and the spot market. This can lead to quick, sharp price movements that make trading riskier during this period. For commodities that requiring physical delivery, holding a contract through expiration means you must be ready to take or give delivery of the actual product. This is usually not practical for most investors, so they close or roll their contracts beforehand to avoid this obligation. Hedgers, who use futures to lock in prices and manage risk, plan their trades around expiration dates to match their needs. Speculators, on the other hand, need to be aware of when contracts expire so they can time their trades properly and avoid unexpected settlement or delivery issues. In simple terms, keeping an eye on expiration dates is essential. It helps you decide when to close your trades or roll over to the next contract. This way, you can avoid surprises, manage liquidity risks, and keep your trading smooth. Knowing how expiration works makes your overall trading strategy more effective and helps you stay in control of your investments.